Welcome back to the Deep Dive. Today, we are putting on our financial analyst hats and focusing entirely on a jurisdiction that's really been a cornerstone of European corporate strategy for decades, Luxembourg.
It really has.
When you look at where international groups and, sophisticated private wealth managers choose to hold listed equities, we're talking large portfolio positions in public companies. Luxembourg just consistently rises to the top.
And the reason is pretty clear. It's about legal certainty, frictionless access to the whole EU market, and I think most importantly, a tax framework that is, above all else, predictable.
Predictable, yes, but definitely not simple. So our mission today is laser-focused. We are tackling the two biggest, most successful, and yet often confused Luxembourg holding vehicles.
Absolutely.
We're going deep on the strategy and the numbers behind the SOPARFI. That's the Société de Participations Financières.
Yeah.
And it's a completely separate cousin, the SPF, the Société de Gestion de Patrimoine Familial.
Right. And what's immediately clear when you look at the sources is that these are not interchangeable. Not at all.
So you can't just flip a coin?
No. While both structures, they can legally hold listed shares, the financial strategy behind them is entirely different. The choice is, it's a material one. It's all dictated by who the investor is.
Are you a corporate group or a family office?
Exactly. Are you aiming for cross-border tax efficiency, or are you seeking maximum simplicity for just passive wealth? Your tax outcome really hinges on that initial decision.
And before we get into the percentages and all the details, let's just clear up the biggest point of confusion right now. People hear SOPARFI, and they assume it's a specific legal entity.
Which it is not. A SOPARFI is really just a descriptor. It's a term for a standard Luxembourg company, an SA, an ARL, that's fully taxable but is just being used primarily as a holding vehicle.
Okay, so it's a regular company doing a specific job, but the SPF, on the other hand.
The SPF is totally different. It operates under a highly specific, kind of ring-fenced private wealth tax regime.
So the SOPARFI is like a standard multi-tool you can customize with exemptions, while the SPF is a dedicated instrument built for one single purpose.
That's a great way to put it. The Soparfi is the high-powered corporate jet. It can fly anywhere, but it costs a lot in fuel unless you hit very specific altitudes. The SPF, it's a sleek, economical sailboat. It can only sail in calm waters, but has almost no running costs.
I love that analogy.
Dude.
Okay, let's unpack the assets. When we say listed equities, what are we actually talking about here?
We're dealing with transferable securities on recognized markets. So your foundational stuff, ordinary and preferred shares, but also things like ADRs, depository receipts, and, importantly, equity ETFs. They're all on the table.
Got it. So let's start with that corporate jet,
Okay.
the SOPARFI.
Right. The SOPARFI is built for flexibility. It can acquire listed equities globally, no geographic limits, and it allows for everything from tiny minority stakes all the way up to majority control. So it's perfect for strategic investors.
But there's a big warning label, right?
A huge one. The SOPARFI is fully taxable by default. So if your strategy involves a lot of transactional activity, true aggressive trading, that's generally taxable unless you hit those really high bars for an exemption.
And that taxable reference is the anchor we need to drop right here. Because if you miss those exemptions, you need to know the default tax hit.
You do.
And the effective combined corporate tax rate in Luxembourg City, using the latest 2025 rate, is a hefty 23.87%.
Exactly. 23.87%. That's the sticker price.
And for, say, a U.S. or U.K. investor, that's a massive hurdle. Nearly a quarter of your gain just disappears. It's almost designed to be a deterrent.
It is. And because that price is so high, the whole strategic value of the SOPARFO centers on achieving what's called the participation exemption.
Okay, and this is the key.
This is everything. It allows dividends and, crucially, capital gains from those equities to be entirely exempt from that 23.87% rate. It basically takes your effective tax rate down to 0 for those holdings.
This is where we need to slow down, because the requirements are nuanced, and they're different for dividends versus capital gains.
They are. Let's start with the easier bar, the dividend exemption. To get 0 corporate tax on dividends you receive, you need to meet one of 2 criteria. Either hold a minimum stake of 10% or have an acquisition cost of at least EUR 1,200,000.
1.2 million euros. And there's a time component too, right?
Yes, you have to hold it or commit to holding it for at least 12 months.
That 1.2 million euro bar, that sounds relatively achievable for a dedicated investment house.
It is. But remember, a strategic investor isn't just worried about dividends. They're focused on the huge capital gain they hope to realize when they sell.
And the bar for that is higher.
Much higher.
Yeah.
This is to discourage pure financial speculation. For the capital gains exemption, you still need that 10% stake or an acquisition cost of EUR 6 million.
6 million, so 5 times higher on the cost test.
5 times higher. The 12-month holding period is the same, but that €6 million cost test is the decisive hurdle for a tax-free exit.
And this is where it gets really interesting, because that difference creates a potential trap. Let's use the example from the sources. Imagine you're a Soparfi, and you invest EUR 2 million in a U.S.-listed chip designer.
Oh.
That €2 million investment easily meets the 1.2 million cost test for dividends. So any dividends you get are exempt from that 23.87% tax. Great.
Right. Good recurring income efficiency. But you are still €4 million short of the capital gains test.
Exactly. So if that stock skyrockets and you sell your position for, say, €8 million, your €6 million capital gain is suddenly not exempt.
And it gets hit with the full 23.87% corporate tax. That is a massive economic shock.
It's wild. So the regulation is basically saying for dividends, 1.2 million proves you're serious. But for capital gains, we only exempt gains from truly strategic positions above 6 million.
Precisely. Now contrast that with a strategic stake in, say, a renewable energy firm where you invest $8 million and hold it for over a year. You cross both bars.
So you get zero tax on dividends and zero tax on capital gains.
That's where the structure truly shines.
So the key takeaway for the listener is if you're planning short-term trades or holding smaller positions, especially under that 1.2 million euro bar, you're paying full freight, 23.87% on everything.
The SOPARFI pushes you towards substantial long-term holdings. And for those holdings, there's one more massive factor, withholding tax. WHT.
Right, from the source country.
Exactly. When your SOPARFI gets a dividend from a company in, say, Japan or Switzerland, that country often imposes a withholding tax. Because the SOPARFI is a fully taxable corporate entity, it can access Luxembourg's huge network of international tax treaties to reduce or even eliminate that tax.
So treaty access is the Soparfi superpower.
It's a huge superpower for international corporate structures, provided you meet the substance requirements in Luxembourg, of course.
Okay, but what if you don't need that? What if your goal is just pure, straightforward, passive, private wealth management?
Then you look at the sailboat.
Exactly. Let's switch gears and look at that specialized tool, the SPF.
Yeah.
This is designed for entrepreneurs and family offices who want simplicity above all.
And this is where the tax contrast is it's dramatic. The SPF pays absolutely no corporate income tax and no net wealth tax. That whole 23.87% discussion we just had, it's gone.
Gone. So what does it pay instead? There's always a catch.
There is. Instead of corporate tax, it pays a minimal replacement fee, the annual subscription tax. And it's set at a remarkably low 0.25% of the total asset value.
0.25%. And it's not just low, it's predictable. The sources say there's a minimum tax of €1,000 and a maximum cap of only EUR 125,000.
That cap is critical. If you're a family office managing a colossal portfolio, knowing your maximum annual tax bill is fixed at $125K provides extraordinary certainty.
But that ultra-low tax burden comes with some very strict restrictions.
Extremely strict. It's ring-fenced exclusively for private wealth. It can't conduct any commercial or operational business. You can't be seen to be actively trading in a professional way.
And no institutional investors allowed.
None. Banks, pension funds, insurance companies, they're all excluded. It has to be private wealth.
So the SPF is cheap and predictable, but it handcuffs your activity. And that brings us back to withholding tax.
Right. This is the definitive trade-off. If the Soparfi's superpower was treaty access.
The SPF's weakness is its inability to use them.
Correct. Because it pays no corporate income tax, it's excluded from treaty benefits. So the SPF typically just absorbs any foreign dividend withholding tax as a final unrecoverable cost.
Okay, so let's connect the dots for the listener. We can now see the two very distinct strategic lanes.
Lane 1. If you need group integration, cross-border goals, or you absolutely need treaty access to minimize foreign WHT, the choice is overwhelmingly the SOPARFI. You're prioritizing efficiency on foreign cash flow.
Even if it means dealing with that 23.87% default risk. And lane 2?
Lane 2. If your core need is pure private wealth management, passive holdings, and you value simplicity and predictability over treaty access, the SPF is the perfect tool. You accept the foreign WHT cost in exchange for that fixed, minimal recurring tax.
Okay, so let's quickly recap the key figures at a glance that define these two pathways. The scary default rate for the Soparfi is 23.87%.
While the annual running cost for the passive SPF is that subscription tax, just 0.25% of asset value, with that very valuable max cap of €125,000.
And the single most critical bar for the SOPARFI to get maximum efficiency, the capital gains exemption, is that acquisition cost of EUR 6 million held for 12 months.
For a final thought, I want you to consider this idea of a progressive buildup, which the sources highlight for sectors like strategic healthcare or deep tech.
The progressive buildup.
Yeah. So if you can't deploy the full 6 million euros immediately, the strategy is to start with a smaller but still significant investment. Then, over maybe 6 to 10 months, you gradually increase your stake until you either hit the 10% ownership or, more likely, you cross that 6 million euro cost bar.
Ah, I see. So you plan the buildup.
You plan it meticulously,
Yeah.
so that once your 12-month holding period is met, the entire position immediately unlocks both the dividend and the capital gains exemptions. It transforms a potentially expensive position into a highly efficient one.
That planning element is everything. Which leaves me with a final thought for you to mull over. Given that the SOPARFI thresholds are based on a fixed acquisition cost, that 1.2 million and 6 million, but the value of your position is constantly changing with the market, how does that initial choice of vehicle and committing to that mandatory 12-month hold impact your strategy if you think you might need a fast tactical exit? You're essentially betting against the clock in the market the moment you commit to the SOPARFI's rules. Something to think about.